And the world's largest pension funds have lost confidence in stocks as the best investment out there. How can we tell? The markets are still in the steepest rally since the 1930s, yet pension funds have not boosted their holdings at all. Let's bring in Bloomberg's U.S. stocks editor, Eric Martin, for more on this topic. Eric, good afternoon.
Good afternoon.
What's on the minds of the pension fund runners, if that's a title? But you know what I'm saying.
Sure, these pension fund managers got enormously scared by what happened last year. We had the worst year for U.S. equities in 71 years, and they were cutting their allocations because they're looking for dependable returns. They have the number of people who are drawing out from these pensions is only growing. The demographics are increasing in terms of the number of people who are looking for benefits from pensions, and so they're looking for lowered volatility, not just from fixed income, but also from commodities and other forms of alternative investment.
Sure. All right. So now that markets have rallied, steepest rally in decades, right, these last couple of months, we're selling off the last couple of days. Pretty sharp sell-off, in fact. So these pension fund managers, do they say, maybe now's time to start getting into stocks a little more?
They're really not looking at stocks as much as a value investment. We had some of the cheapest.
Convinced.
They haven't been convinced by what's been going on because their investment horizon is different than a lot of professional traders and brokerages and investors who are out there. They're looking for more dependable returns, and they've gotten whipsawed twice this decade. In fact, this is the worst decade for stocks relative to bonds since 1900.
But let me ask you this. How is this climate for pension fund managers different? I mean, that's what they want, slow, steady, dependable returns, as you described. So why is this climate different than, say, 20 years ago?
Well, when you look at what's happened over the past decade in terms of the whipsawing of these managers, 2001, 2002, they got crushed again last year. So if you're a manager who's looking for some kind of steady 8, 9, 10% return, you haven't been getting that from equities this decade. You've been getting steep run-ups, as we saw with the tech bubble and as we saw with, if you want to say, the real estate bubble of the last few years. But you're also getting huge drops on the downside. And there's just a lot of pension fund managers who are not looking for that. Their absolute return isn't as important to them as dependable return.
And you're just saying low volatility is what these guys are looking for. Let's talk more about the major market themes. Last couple weeks or so, earnings, jobs numbers in the U.S. driving the stock market. Today, we're hearing more about China. Explain why.
Absolutely. We got a report out of Japan today that said the economy grew, but not as much as economists had estimated. And so this is starting to make people question, along with a earnings report from Ping An, a insurance company in China, is starting to make people question the economic rebound they've been betting on. We saw the Shanghai Composite Index today down the most since November. This is a stock market that has been a debate about, is there a bubble building in China? And today we may have started to see a little bit of that unraveling. And so investors are taking some money off the table, looking at the 50% increase that we saw in 52% increase in the MSCI World Index over the last 5 months and saying, this just doesn't make sense. There's a lot of people who are saying we're not going to see this V-shaped recovery, a straight bounce off the bottom in terms of the economy. So there's a question of have we come too far too fast given all of these headwinds?
Okay. Oh, I'm sorry to interrupt you, but we have unfortunately run out a little bit of time. Eric Martin is stocks editor here at Bloomberg. Thanks a lot.